Siddhartha Bhaiya joins us now. Let's connect with him and let's talk to him about where he feels that markets are headed. Siddhartha, fantastic to have you back. We've got you on a day when for India, Diwali's got extended. For Wall Street, Christmas has come early.
Yes, a massive short covering rally yesterday. Nasdaq up 7%. Today, Hong Kong is up 5%. So they were extremely oversold, the Nasdaq and Hong Kong, and you've seen a little bit of short covering rally over there. But I don't think so. Those markets are out of the wood. But a totally different story for India. I think our numbers look really strong, and yes, the Bank Nifty has made a new high. The Nifty is very close to making a new high. So yes, domestically things look very good.
Siddhartha, when we spoke to you last, I distinctly remember we had a conversation as to why you have a differentiated strategy of not buying into banks.
Yes.
Now, that was the conversation which happened before the earnings season.
Yes.
Post earnings season, it is getting more and more pronounced that banks are not only in a sweet spot, they are also enjoying the benefits of retail credit, corporate credit, and also renewed cycle in CAPEX. Is there a change of heart? Do you think that it's never too late to buy into banks when you see such a pronounced move?
So Nikunj, errors of omission don't hurt as much as errors of commission, right? While the Bank Nifty is probably up 10% over the year, our portfolios are up 17-18%. So as I said, while financials have done well near term, we wouldn't want to own financials in a rising interest rate environment. And near term, the margins they've shown very good margins, but you have to remember that advance growth is far outpacing the deposit growth. So at some point in time, banks will have to raise their deposit rates. Your credit deposit ratio within the system is already at 75%. So from now on, incrementally, banks will have to be very aggressive with their deposit pricing. So money only gets tighter from these levels. The economic growth is very strong right now. Right, we had 13 lakh crores surplus liquidity 2 years back. Today, our liquidity is, we've moved to deficit. So the economy is very strong, and interest rates have to move up from these levels.
So that last time we were chatting, you were talking about as to how we're at the cusp of a large CAPEX cycle. I guess that's already playing out when it comes to manufacturing. But just wondering whether with the likes of defense, you would want to add railways as well to the bag. Because, a lot of people in the market of late are betting on the railway CAPEX theme. And you are seeing the stocks as well give good returns on a month-to-date basis at least.
Yeah. So no, definitely. Again, as I said, CAPEX, as most of the industries have not done any CAPEX for more than a decade. And we're just 1 year, 1.5 years into the CAPEX cycle. This is going to be a very long CAPEX cycle. Most of the capital goods companies are actually net cash positive at this point in time. A lot of the infrastructure, these companies are supposed to have debt on their balance sheet. The valuations are very attractive. So I think, I think Russell Napier came out with a report that the world is going to see a decade-long CAPEX boom. I subscribe to that view. So we're very bullish on infrastructure. And I think that as a sector should do really well. Again, completely ignored. The sector has not done anything for more than a decade. We're very bullish on media right now, right? I think media is going to be a big beneficiary of the growth in the economy. The advertisements are going to go through the roof, according to me. So I think media also as a sector, again, something which is not done well for a long time.
That sounds music to our ears for sure. But
I hope you guys get higher increments and bonuses next year.
Continue listening.
We will see. We'll see who stands right on this one. But tell me, Siddharth, since you are betting so big on CAPEX, that obviously is going to come at, banks getting more business, right? I'm still a little puzzled as to how you're underexposed to banks.
We have zero exposure, to be honest with you. So, and yet we've been able to, outperform all the indices. So, as I said, we are more bottom up, not a lot of top down. We don't hug the indices. We're here to make money for our clients. So, it's fine if the banks have done well, but we own stocks which have done better than the banks.
I'm going to take this conversation forward.
Yeah.
But if banks are growing, they're lending money, right?
Yes.
and the multiplier effect of that is getting created. I'm just breaking it for the benefit of our viewers, Siddharth, just bear with me. So what Siddharth is saying is that I'm not betting on the lenders, I'm betting on the borrowers. Borrowers are borrowing money because they are investing and they see growth coming through. That is the theme what Siddharth essentially is working on. So in our last conversation, which was about...
So Nikunj, you've made a very, very valid point here. We very closely follow where the bank credit is going. Okay. And for a significant portion of the last decade, bank credit globally went to the consumer because interest rates were so low. Right. And now what we are seeing is bank credit is going back to manufacturing. It is going back to infrastructure. It is going to go to the government because interest rates are going up. So the government is also going to crowd out the consumer over the next 5 to 7 years. Yeah, sorry, go ahead.
No, now my next question is, let's understand the consumer.
Yes.
It's been a good year for consumers, whether it is the apparel category, footwear category, hospitality category, travel category. Even autos have made a comeback.
Yes.
As we look into future, now that the base effect has kicked in and also inflationary pressure are there and all of us are feeling the heat of high interest rates. I mean, for me, I'll have to pay much more to service my home loan. That's the real hard fact of life. Is it time to move out of consumers? You're getting an exit pretty much at the peak of the cycle now.
So I think Nikunj, you've made a very valid point here. People are talking about, one inflation print in the US and you had a massive short covering rally. But what we are not understanding is the biggest part of inflation is higher EMIs. For majority of the households, the biggest expense from their monthly budgets is EMIs, and that have gone up definitely. Right. While right now, you're seeing extension of your tenure, at some point in time, banks will have to raise their monthly EMIs, and that is when it will start pinching. So globally, yes, even in India, as I said, from a banking sector perspective, right now we are operating at full capacity. So the NIMs that you are seeing, 75% credit deposit ratio, typically you go back into history. At that point in time, interest rates start to rise. You have no option. Banks have to raise deposit rates if they have to meet credit growth. All the surplus liquidity in the system has gone. Coming to consumers, as I said, as their EMIs increase, the surplus that is left in their pockets will decline. More importantly, look at the valuations. Right? I'm looking at some of the newer listed companies. They're quoting at 100p multiple. You cannot make money by buying stocks at 100p multiple. Period. You cannot. Doesn't matter. And we've seen that with so many of the new age IPOs coming in. We are value investors. We do not believe or do not subscribe to buying stocks at crazy multiples. Doesn't matter. Again, as I said, errors of omission don't matter. It is errors of commission. You have one delivery or one Zomato or one Nykaa in your portfolio, you lose 60-70%, you're never coming back. So, as I said, I would stay away from consumer stocks as well.
Okay, you're going to stay away from consumer stocks. You're very bearish on financials. So, there's a contrary view over there. You're also a chartered accountant who's entered the markets and beaten the markets for the last 2 decades. What I also wanted to just get your views on, when you're talking about the infrastructure story, this, that, and the other, one of the stocks you're very bullish on is Deepak Fertilizers.
Yes.
Why is that the case?
See, I think, Deepak, it's the only manufacturer of technical ammonium nitrate in the country. Okay, very difficult to import technical ammonium nitrate. They are one of 2 manufacturers of nitric acid in the country. Again, very difficult to import. There's a shortage of, nitric acid in the country. TAN growth, given the TAN is used for mining as an explosive. So there is massive increase in demand for TAN. We all know Coal India Productions. The results over the last couple of years have been very good. They've done a massive CAPEX where they're setting up an ammonia plant, which comes on stream in the next 6 months. The kind of savings that they're going to do is phenomenal. Balance sheets for a lot of these companies have improved dramatically. At this rate, in the next 1 year, it is going to be, a debt-free company. So valuations are attractive at 7-8p multiple, revenues in excess of $1 billion plus, a balance sheet which has become very healthy and only improving, and a market leader. It's a market leader in TAN, it's a market leader in ammonium nitrate, it's a market leader in isopropyl alcohol. Not just market leader, he's he's majority of the market. The rest of it is all imports. So he's going to be a big beneficiary, and the rupee has depreciated significantly. So what we have to understand is for a lot of manufacturing exports, rupee is depreciated nearly 10%. That nearly bumps up their margins by 10% because their realizations increase. So a very, very good company. We've been a big caveat here. We've been shareholders here for nearly 9-10 years. So it clearly is not a recommendation to come and buy at these levels.
Okay. You know, when you also say that stay away from consumer-facing stocks, and I was going through your portfolio, you know, that was a question to you, talk about Zomato, Nykaa, the new age companies. But when you say consumer-facing, do you also mean real estate, where we're finally seeing a turnaround after 10 years? You talk about infrastructure. We're seeing the real estate story turn around after 10 years. Motown, auto, the pent-up demand, the robust demand, which we also started to see. You're not interested in that?
No, definitely. We are very bullish on auto. We are very, very bullish on real estate. I think real estate demand, again, is going to be very, very strong over the next 3, 4, 5 years. Very important this, year on year, real estate inventory in the top 7 cities went down by 13%, right? Same thing. Right now, you know, the real estate developers had a lot of unsold inventory over the last 7, 8 years. That sector has not done well in terms of pricing, right? In a city like Mumbai, you haven't seen prices go up significantly over the last 7 to 8 years. As the, you know, the surplus inventory in the system gets absorbed, that is when you're going to see prices of real estate increase, and that is when you're going to see a lot of new launches. So I think, again, you go back a decade and everybody was so gung-ho about real estate. 10 years later, right, the industry did not do anything, and right now we're seeing the signs of revival in the real estate. So I think real estate and autos will do well, very well. We're very bullish on auto, and we've come and said that in the past.
Hi. So I'm going to ask the question I think that everyone wants to know the answer to from you. Not going to talk about Fed, not going to talk about, you know, long-term strategies for sectors. You've identified a lot of stocks that you've held on to for a long period of time, but you're saying now is not the right time to buy. So what is looking good at the current level, or what is it that you think is a ripe opportunity for investors to bank on now for the long term?
I think, as I said, there are certain pockets which are looking attractive. As I said, Infra again has done really well over the last 1 year. So you need to be very, very careful over there. While it might do well over a 10-year period, you could have periods of, 6 months, 8 months. So media looks very attractive to me. Autos look very attractive to me. Pharma is something where value started emerging, right? Infrastructure, again, as I said, looks good. So yes, there are pockets where valuations are very attractive. Sectors have not done well for a very long period of time. But there is a lot of froth in some areas of the market as well. So my tweet at the beginning of this year was that this is going to be a stock pickers market. And I think it has been a stock pickers market. A lot of stocks, you look at it, what are the stocks which are doing well? The 2 big names which were up yesterday in the BSE Mid-Cap Index were GIC and, New India Assurance. You look at the defense stocks, whether it is Cochin or Mazgaon, nobody is talking about them a year back. Who has led the rally in the last 1 year? It is ITC, it is State Bank of India, it is Mahindra and Mahindra, it is Coal India. Nobody is talking about these stocks. So as I said, a contrarian approach in the long run always works. Buying the popular names doesn't give, doesn't make you money in the long run, as Buffett said.
I'm wondering with, after the changed commentary from all of these new age tech companies, and we saw that from Zomato just yesterday, with the focus in profitability, talking exactly what the markets want to hear, and after the crash that's come by in this entire space, whether you're a buyer in any of these names?
So to be honest with you, out of a lot of these new age companies, there will be a few of them which will eventually become, a lot of people talk about Amazon, but what you have to remember is of all the tech stocks that came out in 1999, Amazon was the only survivor. What is the probability of you finding out the next Amazon? Right. So I'm sure there are a couple of them out there, even amongst the unlisted space, which will do really well. But I feel a lot of them, maybe more than 95% of them, will eventually go bankrupt. So yes, Zomato has huge power. It has huge scale. It has a pan-India presence. We would want to, but it still doesn't reflect value. It doesn't fit within our matrices. So I'm very happy not owning them.
Yeah, appreciate your time and so glad you could join us. Thank you for joining us. It's good to get a very differentiated and a very refreshing voice as to how you can still outperform without buying into banks, which in a sense has become the easy and the most consensus trade.